School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 2 Overview of Indian Economy, Unit 5 Indian Financial System Part 1. After completing this unit, you should be able to explain the importance of the financial system, describe the structure and working of the money market and capital market, outline the structure of the banking system, and examine the working of the capital market along with its various instruments and intermediaries. Introduction. Before dwelling into the various intricacies of the financial system, you need to understand capital accumulation and its importance. In the previous units, you have learned about different theories of economic growth and have realized that for an economy to achieve higher levels of both economic growth and indeed economic development, the role of capital formation is indispensable. Capital formation means an addition or increment in the existing stock of real capital available in the country. Capital in economics terminology does not mean money alone. It is a wider term that encompasses both physical and human capital. Physical capital like machines, tools, infrastructure, raw material, etc. leads to more production, profits, and the creation of assets in future. Human capital, on the other hand, includes skills, training, education, etc., which improves the productivity of individuals and especially labor. Saving and investment are two core components of capital formation. Saving in the simplest sense means the part of income that is not consumed. When saving is used in such a manner that it gives returns in future and it becomes an investment. For example, you saved a certain proportion of your income and bought a piece of land. So buying land is an investment because if you sell it, then the sale price of land will be higher than your purchase price, and the margin between the two will be the profit. Now, instead of selling that land, you constructed a building on that land and then you gave it on rent. So this rent will be an extra income for you and it will add to your current level of income or profit. So when savings are properly channelized, it increases the stock of income or capital. As saving is important for an individual, it is of paramount importance for an economy. A higher level of savings leads to more investment and capital formation, which in turn becomes the source of economic growth. So, it is the creation of savings, mobilization of savings, and conversion of savings into capital assets that lead to capital formation. There are a large number of factors that affect the rate of capital formation in the country, like income levels of the people, institutional factors like availability, number and coverage of financial institutions, the monetary and fiscal policy of the country, prevailing rate of interest, population, size of the market, etc. Financial system and working of financial markets. A financial system consists of a set of institutions, instruments, and markets which brings the savers and the investors to a common platform and provide the means by which savings are translated to investment. The principal objective of the financial system or financial markets is to channelize the savings into the most productive opportunity or avenues. In financial markets, there are two players, namely lenders and borrowers. Individuals or households generate savings and have surplus funds. They can either put this amount of money in gunny bags and hide it or keep it under lock and key, as was done in yesteryears. This form of savings did not yield any return and the constant fear of theft always lord upon the savers. On the other hand, capitalists or entrepreneurs could not undertake new projects of production or expand the existing production capacity of the plant due to a dearth of capital. The major role of the financial system of the financial market is to bring these two together. Those who have savings, savers or lenders put funds into banks and other financial institutions, and those in need of money or finance, that is borrower, take the money from these financial institutions. In this interaction, both the lenders and borrowers gain, and ultimately, due to increased efficiency, production and exchange, the whole economy gets benefited. The households save money in the financial system, and these funds channelized in the form of loans and are provided to the borrowers. Financial markets perform many functions like number 1, to connect borrowers and lender of funds and to lead to the process of price discovery or determination. Number 2, to provide liquidity in the system by allocation of funds in an efficient manner. Number 3, easy access of funds to the borrowers, which in turn reduces the cost of the transaction. And number 4, provides a way for managing uncertainty and controlling risk. Structure of money market. Financial markets have two main components, money market and capital market, and they both are essential for the economic development of the country. In the upcoming section, you will learn about the money market, its importance and various instruments. The money market is a market for short-term financial assets and assets which are close substitutes of money. Short-term implies time period of less than 1 year, and close substitutes of money refer to those financial assets that can be converted to money with minimum or no transaction cost and without loss in value. The major participants in the money market are scheduled commercial banks, excluding regional rural banks or RRBs, cooperative banks, excluding land development banks, and primary dealers, that is PDs. Objectives. The broad objectives or functions of the money market are: number 1, to provide equilibrating mechanism between short-term surpluses and deficiencies. Number 2, maintaining liquidity in the system. Number 3, providing access to short-term funds to the borrowers at minimum or realistic cost. And number 4, to enable the central bank of the country for intervention to influence and regulate liquidity in the economy. Instruments of the money market. The main instruments traded in the money market and the sub-market are: number 1, call market or notice market. Number 2, commercial papers or CPs market. Number 3, treasury bills or T-bills market. Number 4, commercial bills market. Number 5, certificate of deposits or CDs market. And number 6, money market mutual funds or MMMF. Let us now discuss all of them in brief. Number 1, call market or notice market. It is a market for short-term financial funds that are payable immediately and in full when the lender demands them. It is for this reason that call money is also known as money at call. The maturity period varies from 1 day to a fortnight, that is 14 days. When the funds are borrowed or lent for a day, it is called overnight money. If the duration of funds borrowed or lent is more than a day and up to 15 days, it is called notice market. For conducting transactions in the call or notice market, there is no need for any collateral security. The major players in the call market are banks and primary dealers. The interest rate payable on call loans is known as the call rate. Number 2, commercial papers or CPs market. CPs are short-term unsecured instruments issued by companies to raise short-term debts. They are issued in the form of promissory notes, and in India they were introduced in 1990. Large corporations, primary dealers and financial institutions are authorized to issue CPs. The maturity duration of CPs is a minimum of 7 days and a maximum of up to 1 year from the date of issue. They are typically issued to short-term financial obligations like funding of the new project. They can be issued in denomination of rupees 5 lakh or multiples thereof. Further, all eligible participants need to obtain a credit rating for the issuance of CPs. They need to have a minimum credit rating of A2 as per the Securities and Exchange They need to have a minimum credit rating of A2 as per the Securities and Exchange Board of India SEBI definition and rating symbol. CPs are issued discount to face value basis. They have many advantages like the option of diversification for the source of finance, high returns and liquidity. Number 3. Treasury bills or T-bills. T-bills are short-term borrowing instruments by the Government of India. These are a form of a bill that does not arise from any genuine transaction in goods. They are a kind of promissory note issued by the Reserve Bank of India, that is RBI. The government uses T-bills to raise short-term funds to bridge the temporary or seasonal gaps when a deficit arises due to shortfall, that is, situation when receipts fall short of expenditure. At present, T-bills of 91 days, 182 days and 364 days are issued. These bills are bought and sold on a discount basis, means they are zero coupon securities and yield no interest. For example, a 91 days T-bill of rupees 200, which is the face value, may be issued at say rupees 198.2, so the discount on this T-bill is rupees 1.80. And at the time of redemption, it will be redeemed at the face value, that is rupees 200. The return which investors gain is the difference between the face value, that is maturity value, and the issue price. T-bills are issued by RBI through auctioning. RBI conducts auctions of T-bills with a maturity period of 91 days, 182 days and 364 days every Wednesday. The date and place of auction, maturity time period and the method of auction is announced by the RBI from time to time. There are two main types of auctions, namely multiple price auction and uniform price auction. The main features of T-bills are: number 1, they are negotiable instruments. Number 2, highly liquid because of the short time period. Number 3, secured as they are backed by the government guarantee. And number 4, assured yield and low transaction cost. The net short-term market borrowing of the government through 91 days, 182 days and 364 days T-bills stood at Rs 37,528 crore during 2019-2020. Number 4. Commercial bills market. Commercial bills include bills of exchange and promissory notes. A promissory note is a form of financial instrument in which the note's issuer and the note's payee undertake a written promise whereby the issuer promised to pay a definite sum of money either on demand or at a specified future date to a particular person or to the bearer of the instrument. Commercial bills originate due to original trade transactions. There are many types of bills like trade bills, commercial bills, inland bills, foreign bills, indigenous bills, and others. Rediscounting of bills is an important segment of the bill market. Commercial banks often make use of such facilities. Let us understand the concept of rediscounting with the help of an example. Suppose a commercial bank buys 91 days T-bill at rupees 1000 and receives rupees 1100 at the time of maturity. In this case, the difference between the purchase price and face value of the bill is rupees 100 and it is called the discount. Rediscounting occurs when the short-term negotiable debt instrument is discounted for a second time. In continuation with the above example, let's assume that the same bank needs money urgently for say 30 days. It will approach the central bank of the country and the central bank can purchase some of the bills from the bank, say for rupees 1050 for a period of next 30 days, but before 90 days the date of maturity. In this case, the rediscount or the difference between the purchase price and the face value is rupees 50. Number 5. Certificate of Deposits or CDs market. CDs are negotiable money market instrument against funds deposited in a bank or other financial institutions for a fixed time period at a specific rate of interest. They are the bearer documents and issued in dematerialized form. Scheduled commercial banks, except RRBs and local area bank, and selected all India financial institutions can issue CDs in a minimum amount of Rs 1 lakh and in the multiples of Rs 1 lakh. The maturity period of CDs is a minimum of 7 days and a maximum of up to 1 year. They are issued at a discount on face value. Banks have to maintain appropriate reserve requirements, that is cash reserve ratio or CRR, and statutory liquidity ratio, that is SLR, on the issue price of CDs. And number 6, money market mutual funds or MMMFs. To increase the participation of individuals and small investors in the money market and to provide additional short-term funds avenues to the investors, MMMFs were introduced in April 1991 and the detailed scheme of MMMFs was announced by RBI in 1992. A mutual fund is an investment scheme mostly run by an asset management company. Money is collected from a large number of investors and this pool of money is invested in stocks, bonds and other securities. Mutual funds are mostly beneficial for small investors like the salaried class who park their funds in MMMFs and can gain better returns. They offer diversification of short-term assets in terms of issues, maturity and volume, thereby spreading the risk. Whenever investor buys mutual funds, they are allotted units or share of the mutual fund. These mutual funds are professionally managed and investors earn income in the proportion to the number of units owned by them. Initially, only banks, financial institutions and their subsidiaries were allowed to set up MMMFs, but corporates and others were allowed for the same from 1996. All money market mutual funds are governed and regulated by SEBI. Structure of money market in India. The money market is divided into two parts, that is organized and unorganized. The organized sector consists of the Central Bank of India or RBI, commercial banks both nationalized and private. Further, foreign banks, cooperative banks, the Discount and Finance House of India and other financial institutions like IFCI, ICICI, LIC, GCI and mutual funds also operate in the money market. The unorganized sector consists of non-banking financial intermediaries, indigenous bankers and money lenders. Banking structure in India. As discussed previously, banks are one of the most important segments of the money market. Let us now learn about the banks, their functions, the structure of the banking system in India with special reference to RBI. Definition of bank. According to the Banking Regulation Act 1949, a banking company is a company that transacts the business of banking in India, and banking means accepting deposit of money from the public for the purpose of lending or investment, however, with the promise of repayment on the demand by the depositor with the facility of withdrawal by check, draft, order or otherwise. The functions of banks have changed from traditional, that is accepting deposit and lending credit, to many more functions like collection and payment of checks, bills and promissory notes, sale and purchase of securities, remittances of funds, merchant banking, services of automated teller machines, that is ATM, electronic fund transfer system, dealing in foreign exchange and others. At the helm of the affairs, there is RBI, which is the regulator of the banking sector and supervises the monetary policy of the country. After that, we have scheduled banks that are further classified as scheduled commercial banks and scheduled cooperative banks. Scheduled commercial banks further classified as public sector banks, private sector banks, foreign banks, and regional rural banks. Within the public sector, there are nationalized banks and the State Bank of India and its associates. Private sector banks have two categories, old and new private sector banks. In the upcoming sections, you will learn about them. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Jagbandhu Jana. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.